Welcome to the Retire Mentorship Workshop on reducing taxes in retirement. I'm your host, Freeman Lindy, host of the Retire Mentorship Podcast. And before we get started, let me ask you a question. What is your largest lifetime liability? What expense is going to cost you the most over your lifetime? Is it cars? Probably not, unless you have really expensive taste in vehicles. Is it your house? Well, a lot of times that's the largest single purchase you'll make, in the hundreds of thousands and for some people even the millions of dollars. But a house can be paid off, and once it is, it's no longer an expense. In a lot of ways, it can even be looked at as an investment and not an expense. So it's not your house. It's taxes. Taxes are the largest liability, the largest expense that most people will pay over their lifetime. And so that's why we want to look at, for those of you who are approaching retirement, even in retirement, it can still be the largest expense that you will pay. And so we need to do whatever we can to help you reduce that expense and keep more of your money in your pocket. Before we go any further, make sure that you get the workbook. It's free to anyone who is a RetireMember, which is our free membership community as part of listening to Retire Mentorship. You can go to retiremembership.com to find out more and sign up if you're not a member, right? If you just found this video after the fact on YouTube. But many of you will have signed up through a link, an invite, because you're already a RetireMember. Make sure you pull up that workbook that was emailed to you on the day of the recording. Otherwise, you can click the link in the description of the video. It'll take you right to those workbooks. You can sign in as a RetireMember and grab that workbook. It'll help you follow along, help you take detailed notes. We're going to cover a lot of content, and so you're going to want to make sure you have something to take away and be able to get the most out of it. So make sure you do that. And then if you happen to find us not through the podcast, you don't know, we do have our Retire Mentorship podcast. It's your mentor to and through retirement. And each week we cover different topics from behavioral to psychological to just tactical ways that you can retire successfully and stay successfully retired. So it's your weekly dose of inspiration, of motivation, of knowledge, of information, all those things. And you can find it wherever you get your podcasts, or you can also watch it on YouTube. We've been doing that now. You can watch or listen, whichever you prefer. And so you can subscribe to this video channel to get more details on that. And that's where most of our content comes. We have monthly workshops in addition. This is the third one. We've had two other ones, one on investing and one on Social Security. So you can check those out in the channel as well. And then lastly, before we get really jumping in on reducing taxes, of course, we got to make this disclaimer, right? This is not tax advice. This is educational content, right? We just want to educate you, give you some information, but I don't know you. I don't know your situation. I don't know your tax. I don't know anything about you because you're just a listener, unless you're a client of mine. And then we've already done all this tax planning. But, and a lot of this information will become outdated potentially the day after this is published, right? Tax rate laws are always changing. A lot of these strategies may become obsolete as Congress decides to change taxes again. So this is these strategies are current as of today, November 17th, 2022. But they, if you're watching this a year or two from now, they might not be valid anymore. So make sure that you get specific tax advice from a tax professional and a financial planner that's related just for you, and that this is not tax advice, right? Okay, so this is what we're going to cover today, right? We're going to first talk about why you need tax planning, why we need to be planning and proactively looking forward and making sure that we are reducing taxes in retirement. And then we want to look at the 3 inbound tax bombs that you have to look forward to in retirement if we're not doing that planning. These things that can blow up your plan, that can cost you way more on extra taxes than you ever want to pay. And then, of course, we'll look at some strategies to reduce those taxes. So let's jump right into it here. First of all, now this is totally my opinion, right? But I think that you have a moral duty when it comes to taxes. You have a moral duty when it comes to taxes. So let me ask you this, right? Who's going to do a better job with your money, right? You or the government? And as you see these underlined, words in the video here, that is, of course, places where you can put in the workbook, or there's blanks in there, and those are the missing words for those. So again, make sure you get that workbook. You can follow along and fill in the blanks in the workbook as we go along. But again, who's going to do a better job with your money, you or the government? And I would say you, right? And therefore, you have a moral duty to pay the least legal taxes that you can in your lifetime, right? That you have a moral duty to pay the least amount, legally, the least amount of taxes you can. Now, obviously, we have to make a distinction here, right? And that tax avoidance is 100% legal and encouraged. It's the point of tax planning. It's why we do this, right? Because there are ways to avoid paying extra taxes. Now, that's way different than tax evasion. Tax evasion is a felony, and you can go to jail for that. So we're not doing anything illegal here. I'm not teaching any ways to hide money from the government or hide money from the IRS or any of those things. Everything we talk about is 100% legal, 100% geared towards tax avoidance, not evasion. Tax evasion is how they got Al Capone, so let's not be into any of that. But it's your duty to pay the least amount of taxes. And so let's look at that. Like, what is the difference then between tax planning and tax preparation? If you follow the podcast, you've probably heard me talk about this before, but in case you're brand new, let's run through this. Tax preparation, right? That's looking backwards, right? It's calculating how much taxes did you owe on last year, right? We file taxes between February and April 15th, unless you're late. And I was looking back at the previous year and saying, hey, how much did you earn? What are your deductions and credits that you can get? And how much in tax did you owe? Did you withhold enough? If not, you got to pay. And if you withheld too much, you get a refund, right? So that's looking backwards and good tax preparation, right? Finding the right credits, finding the right deductions. Like, you need that. Tax preparation is key, and CPAs and tax pros are really good at doing that. But the whole point of that is to reduce taxes in just 1 year. If you got a really good CPA and they're really involved with your situation, they might look forward and help you reduce taxes over the next couple of years. But for most people, their tax preparation is just that. They're just trying to reduce the taxes they paid last year. That's it, right? What tax planning does is tax planning looks forward, right? We're looking out into the future to estimate the taxes that we're likely to pay over our lifetime, over many years. And how do we reduce those taxes? Not just in 1 year, but over your whole life. That's what tax planning aims to do. And it's kind of like when you're driving, right? You don't want to be driving looking in the rearview mirror. You want to look through the windshield. And last year, it's just 1 year. It's a tiny snapshot of your life. And so trying to do good tax planning or trying to be proactive on your finances by only doing tax returns and looking at that 1 year last year is foolish. We need to be looking through the windshield at the overall life, everything we have forward. There's way more ahead of us than there is backwards, at least as far as things that we can control tax-wise. And so we want to be proactively planning instead of just reactively preparing. And so that's the key difference there between planning and preparation. And the difficulty, I think, in good tax planning is that, well, one, your financial representative or your financial advisor can't give tax advice. They're not licensed to. They've got securities licenses or financial plan licenses or insurance licenses, those types of things. But they don't have any tax license. And of course, in the U.S., right, everything you have to have a license to be able to do. And even if they wanted to get licensed, a lot of times the companies they work for don't want to take the risk. Like, that's not their lane. Stay in your own lane. Don't talk about taxes. And so what you'll often get with your financial advisor is you ask them a tax question. I'm sorry, I can't answer that. Go ask your tax advisor, right? And your financial advisor just won't ask it. And I've even heard stories of, people saying like, hey, should we be doing asking their financial advisor, hey, should we be doing a Roth conversion? Say, I don't know, ask your tax advisor. And so then they go do that, right? But here's the problem, right? Tax professionals, CPAs and enrolled agents and, H&R Block and TurboTax and all these things, they typically don't plan. So financial advisors don't give tax advice, and tax professionals don't plan, right? Half the time they don't have time. That's the number one thing, right? They're doing 300 to 500 tax returns in like 3 months, right? And so they don't, it's just in and out, churn, trying to get through as many tax returns as they can. And for most people, the only time they talk to their tax advisor is during the tax season, when they're harried and flustered because they got hundreds of returns to do in a very short amount of time. So they don't have the time to really dig into your situation and plan forward. They got their hands full just looking at last year. And beyond that, they really just don't know your other financials, right? Like, all they have is the documents you give them. They don't know what's in your 401k. They don't know how much is in your IRAs. They don't know what your Social Security is going to be. They don't know how much you spend in a year. They don't know any of these things. And so they can't really do good planning for you because it's just not what they do. It's not that they can't do it or that they're, incompetent or anything. It's just not what they do. They look at last year and help you save taxes in that 1 year. And so what you're going to get from your tax advisor is, hey, go ask your financial advisor, right? And so you have people that will go and they'll ask, their financial advisor, hey, should we do a Roth conversion? Hey, go ask your tax advisor. They'll go do them. Hey, should we do a Roth conversion? I don't know. Go ask your financial advisor. And it's like, how do you, it's a catch-22 for a lot of people. And so what we really need then is some certified expertise that can do both. And so what we always look for, and it's kind of where I can come in, I think, help you out a lot in this, is that, so I'm a fee-only fiduciary, which means that I don't earn any commissions on anything. I don't sell any financial products, no insurance, no anything. So no commissions ever. And I'm only giving advice in my client's best interests, always. So if something's ever, if it's not good for them or it's not as good for them, but it's better for me, it doesn't matter. I can't recommend it. It always has to be in their best interest. So I'm not here to sell you anything. There's no big product things. It's not like, hey, by the way, in the end, like an annuity is going to solve all your problems and you should invest in annuity because of tax deferred, blah, blah, blah. No, I don't sell any of that stuff. And so, there's no gotcha. There's no big sale coming at the end of this presentation. Second, I'm a certified financial planner. So that's the gold standard in comprehensive advice. So we are, I know all the things, all the strategies for just general financial planning, right? I wrote a book on it. We've got all this content that we're doing on it. So have that expertise there. And then lastly, I'm also an enrolled agent, which is the federal license to prepare taxes and give tax advice and represent taxpayers in front of the IRS. So like if you have a problem and I'm doing your taxes, I can represent you to the IRS. You don't even have to go talk to them. And so for us, like we don't hang a tax shingle. We don't do taxes for people who are not our normal clients, but we actually go and do our taxes, like tax preparation. And of course, tax planning is included in the services that we offer to our clients. And so not only do I know a lot about taxes, I'm actually doing them, right? And it's, there's hundreds of hours to get the enrolled agent license and I have to do 24 hours of continuing ed every year just on taxes, let alone the 30 plus that I got to do for financial planning. And so I'm spending hours and hours every year making sure that we're staying up on top of these things. And I don't know about you, right? But you probably don't want to be spending 24 hours a year studying the changes to the tax code. That's just not something you want to be doing. So I'm one of there's more like me. They're out there. But I'm in this unique situation where I've got expertise on both sides, on the tax side and on the financial planning side. And so we can come together and really get some good tax strategies for you to help you reduce taxes in retirement. So, and again, of course, we do financial and tax planning for our clients. And again, this is not financial and tax planning for you because I don't know you, but here's the educational piece that we teach our clients. So I'm giving you all the education that I give my clients. I'm giving that to you for free. And of course, there's, you're going to have to work some things out and do some calculations and all that. And of course, we do all that for our clients, but at least you kind of can see the same things that we work with our clients there. So what are these inbound tax bombs, right? What were we talking about before? And we know how important it is to avoid these, but what are we trying to avoid? And there are three of them, right? There are three tax bombs that are threatening people age 50 to about 70 or so. That's my main focus. Those are my main clients are in that age category. And there's three bombs that are coming their way. Number one is tax rates. And we're going to talk about that one first. Number two is RMDs. And number three is inheritance tax. And, these three tax events could end up costing you tens or even hundreds of thousands of dollars in extra taxes, right? We're always going to have to pay taxes, but these could cost you thousands and thousands of dollars in extra taxes if we're not aware of them and not planning for these huge tax bombs. And of course, we're going to pay every dollar of taxes that we owe, right? There's no tax evasion happening here, but let's not leave the IRS a tip. Let's not pay any extra taxes on top of what we have to pay. And so that's what we want to do. So we're going to look at each of these tax bombs and then look at some strategies to avoid them. So what we're going to do now here is we're going to switch over to a little whiteboard here and we're going to teach you a couple things that, again, I teach my clients a lot. And we're going to run through a few things. A lot of this you probably already know, but we want to make sure that we're all on the same page. So what you're going to have here, what's going to come up is some different retirement accounts and how they function. Again, you may know some of this, some of it may be new to you, but we're going to go make sure we're all on the same page before we dig a little bit deeper into some of these strategies. And so there's two different kinds of main tax accounts that we have, right? The first ones are traditional tax accounts. And those are things like traditional IRAs, traditional 401ks, 403bs, 457s, all these different types of accounts. And when it comes to these retirement accounts, as you probably know, contributions go in pre-tax. So we're not taxed on those contributions on the front end, right? We don't have to pay any taxes on those. taxes in any retirement account grow tax deferred. So as long as the money is in the account, it's not being taxed as it continues to grow. And it's only when you pull money out of a traditional 401k or traditional IRA, that is when it's taxed on the back end, right? So it's pre-tax up front, gross tax deferred, comes out taxed in the end. The other main type of account, of course, is a Roth IRA. And these accounts are basically the opposite, where you are now taxed up front. You're taxed on any money before you're able to put it into the Roth. It's still going to grow in there, tax deferred, like in all retirement accounts. But then when it comes out, withdrawals are now tax free. And we don't pay another dime on any taxes on any Roth accounts. There's a couple other accounts, down in here that we're going to talk about a little bit later. But for now, those are the main things that we are looking at. And so a big question becomes then for people, well, which one should we do? Should we do traditional or should we do Roth? And so there's always this big question, right? To Roth or not to Roth? And so what I want to do quick for you is kind of break down how might we think about that. And the way that I like to think about that is just let's do some math, right? And let's say we have at the beginning of a scenario, we got $1,000 just for easy math, right? And so we got $1,000 and we could either put $1,000 into a traditional account or we could put $1,000 into a Roth account. And let's say that taxes right now are 25%. So any money we earn, we're going to pay 25% in taxes and then we can, do whatever. Well, do we pay any taxes on the traditional account? No, we don't. So we're going to pay zero taxes if we put that money into a traditional IRA or into a 401k. Are we going to pay taxes on a Roth account before we put it in there? Yes, we are. And so if it's 25% taxes, we're going to pay, what would that be? $250 in taxes here, right? And that means that the actual contribution we're able to put into these accounts is going to be $1,000 into traditional, but it's only going to be $750 into a Roth. Then let's say that these things grow, right? And let's say that they double over some amount of time between when we put the money in and when we take it out. And so in the end, our $1,000 has grown to $2,000 and our Roth money has only grown to $1,500. And this is why when you ask a lot of CPAs or tax professionals, hey, which one should I do? They will almost always tell you to do traditional. Because what they're looking at is, hey, if you put it in traditional, then you have to pay no taxes here. So you're going to be able to put more into a traditional than you can in a Roth. And then down the road, when all that grows and grows and grows, you're going to have way more money in a traditional than you are in a Roth, right? Just add a couple more zeros on the end of that if you want to see how this looks over a lifetime, right? Not a huge difference between 2,000 and 1,500, big difference between 2 million and 1.5 million. And so a lot of times they'll tell you, hey, go ahead and do that Roth. It's going to be better off. You're going to have, or that traditional, you're going to have way more money in the long run doing it that way. But here's the deal. The question really becomes, what are taxes now at the beginning and what are taxes going to be at the end? Right? And so, for example, if taxes happen to be the same, 25%, well, yes, you've got more money in your traditional than you do in your Roth. But do you really have more money if you haven't been taxed on it yet? The answer is no, because we still need to pay those taxes. And so when we withdraw that money, if we pay 25% taxes, that's going to be $500 from the traditional, and we're going to end up with $1,500. And if we are pulling money out of a Roth IRA, do we pay any taxes on that money that's in there? No, we do not. It's tax-free, right? Withdrawals, as long as you meet all the requirements, withdrawals are tax-free. So we're going to pay zero in there, which means that in the end, we're left with $1,500. So in the end, it doesn't matter. It's exactly the same, right? Doesn't matter. And that's the key distinction, right? If tax rates are the same, when you put it in and when you take it out, it doesn't matter. It's a complete wash, whether you do traditional or Roth. So this is the main question then. Are tax rates going to be the same? And how much are we likely to pay in tax rates? So what are the tax rates? What are we looking at as far as this goes? And you may know this, and this may be way more information than you ever wanted to know about taxes. But I think it's important to at least understand this one time. And after you've done your tax planning, or if you're outsourcing this to a CFP that can do this for you, great. You never need to know this again. But at least one time you should understand the concept behind tax planning. So if you are If this is a married filing jointly rates for 2022, and they're all rounded off for just easy communication. All these numbers change each year, they inflate, and it's obviously different if you're filing single or filing head of household or married and filing separately. But we'll just use this one example for now. Right now in 2022, recording this in November of 2022, the first $26,000 that you earn, you pay 0% taxes on. Right, because everyone gets a $25,900, basically $26,000 standard deduction in 2022. If you itemize, you might be able to get a higher deduction than that, but at least everyone's going to get at least this amount of a standard deduction. There's other credits, other deductions, other things you can get that can make it even more, right? But we're just basic, standard, at least everybody gets this. Everybody gets $26,000 at 0%. The next $20,000 that you earn is going to get taxed at 10%. It's going to pay 10% on the next 20 grand. The next $64,000 that you make, so all the way up to about 110 total of household income, is going to get taxed at 12%. So there's a small window here, it's only about 20 grand, and a bigger window here that's going to get taxed at 12. Not a huge jump though between 10 and 12 either, right? But then the next $95,000 here, all the way up to about 205 total, is going to get taxed at 22%. So there's a nice 10% jump there between any money that you make over $110,000 in 2022. And then the next tax bracket is 24. And there's $161,000 that you can make in that tax bracket. So it keeps getting bigger, right? The amount of taxes in each one keeps getting bigger and bigger. And there's, again, not a very big jump between these two. And then over 366, you're getting taxed at 32%. And there's a couple more brackets after that, but I doubt anybody who's making that much money is watching this. So we'll stick to it for now. And of course, I got this little line in here because this part's not to scale, but the rest of it basically is. So that's the taxes you're paying right now. Depending on where you earn, right, that's where you're going to be. So when we're discussing like, hey, what's our beginning tax rate? How much are we paying at the beginning? And we're trying to compare how much we're going to pay at the end. We got to at least know, hey, right now, at the end of 2022 here, right, we got a little bit left in this year, and then we got 23, 24, all these other years. How much in taxes are we paying? So if your household, right, makes $150,000 gross before taxes, before anything else, you're probably right in the middle, between 110 and 205, you're probably right in the middle. That, you're not paying 22% on all of your income, right? Just on that amount over 110. But that's basically what you're paying. And so if you do traditional, like this is your gross amount, and you throw 20,000 or so into a 401k, a traditional 401k or an IRA, then, you're going to bring down your taxable income by that amount, and you're going to save 22% on that money. And so all the tax strategy that we do, any credits, deductions, strategies, all those things, they're always going to affect your highest marginal tax rate because it layers on top of those. So it doesn't affect, things we do aren't going to affect these lower ones. That's why we want to know what's our highest one. So let's pay attention. If you don't know or if you haven't figured it out, right, go get your last tax return and figure out what was that total income amount, and you can basically figure out where your highest tax rate is. So then we got to decide if we're trying to do tax planning, trying to save the most amount of taxes over a lifetime, keep the most amount of money in your pocket. What should we do? Traditional or Roth? Well, what is taxes going to be in the end then, right? When we withdraw it, how much are taxes going to be at that time? And something you should know right off the bat is there's this huge delineation right here between 2025 and 2026. Because where we're at right now is we are in the Tax Cuts and Jobs Act, which went from 2018 through 2025, and that's where we got all these rates. And after 2025, in 2026, the Tax Cuts and Jobs Act expires, or at least a lot of the provisions, including these tax rates, they all expire and they go away. And then tax rates are going to resort back to what they were before Tax Cuts and Jobs Act. So we're all used to these now, and we think this is the way they've always been, that we should be, but they actually used to be higher before 2018. And they're going to go back to that. And so this is what we're going to do first, right? All these numbers will inflate by then, but in general, the first $26,000 inflated for inflation is still going to be 0%, right? We're still going to get that standard deduction. This might actually come back down because it used to be lower than that, but we'll just pretend for now that at least they'll keep that intact. The next 20,000 or so will still get taxed at 10%, so that doesn't change either. But this is where it starts to change. Anything over $46,000 that you make as a household is now will get taxed at 15%, right? Anything that used to be taxed at 22, if you make more than $110,000 as a household, or will in retirement, right? If you're retiring somewhere in here, that's going to now get taxed at 25%, right? So we got a 3% jump here, a 3% jump here. The 24 is going to go to 28%. So there's a 4% jump there. These other ones change a little bit, but some of these lines also change on where it cuts off. And so all the tax rates across all sections, they all go up by 3 to 4%, which means that, if you're making a bunch of money and you're making, $50,000 over and above this one where it doesn't change, all of a sudden overnight you're paying an extra $1,500 a year in taxes. Just like that, possibly for the rest of your life. Now, right, they might make some of these other cuts permanent, but they're not going to for the upper ones. Can't imagine that, right? They just give away trillions of dollars in free COVID money, and now they're trying to forgive loans and all these other things, right? And so they can't just keep printing all this money and then keep tax rates lower. They're going to eventually, these taxes are going to have to come back. So we already know, right? If tax rates are the same at the beginning and the end, then nothing changes. If they go down, right? If they pay, if they go down to 20%, then you will not want to pay taxes at 25% to avoid them at 20, right? But we don't think do you think taxes are going down? I don't think so. At best, they're going to stay the same, right? They might make these tax cuts permanent. I doubt it, but they might. And if that's the case and you do a Roth conversion, it's not going to matter, right? But I think in general, unless they do anything, a bunch of these rates are going to go up, and they probably have to, right? We're in tons of debt. We need to do something about this. And so the question becomes, especially if you're retiring somewhere in here or even after, where are you now, right? If you're in the 22 now, are you still going to be in this bracket later? Some people, right, they earn a lot pre-retirement, right? And they're putting a lot into retirement, and they're planning to, hey, once I retire, we're going to live a simple life, and maybe we're going to be down in here. And other people, they're like, hey, we're putting away a lot, but as soon as we retire and have all this freedom, we want to travel, we want to do fun things. And they're actually planning to spend more in retirement than they were before. So here's the general thing that we want to look at, right? Is that if tax rates are lower in retirement, then you should do traditional, right? If we are earning a higher tax rate now, and then later on in retirement, we're going to be at a lower tax rate, then we should, avoid the higher taxes now with our high income, and then take that money out at a lower tax bracket later in retirement. If tax rates are higher in retirement, right, because, we're planning to stay in that same tax bracket, or we're planning to spend more and the tax rates are going up, right? Then we should do Roth now. We should pay those taxes now while they're lower. And then when tax rates go up in 2026 and beyond, then we'll be able to avoid those higher tax rates later. And if, tax rates and tax brackets, they change. And again, are they going up or down? And to me, I got to assume that they're going to keep going up, right? The taxes are just going to get higher and higher. And so to me, that's a really good case for a lot of people to do Roth, to either do Roth contributions or Roth conversions and pay those taxes now and avoid paying those later. All right, so we have those tax rates. And so here's the question, right? So here's what we can do, right? First, we need to calculate your taxable income in retirement, right? We calculated it now. Then you need to do some retirement planning, right? Some financial planning, and really figure out, hey, how much are we planning to spend in retirement? What's our taxable income going to be there? And so we got to figure out what that income is going to be. Then we need to estimate then our taxes based on these brackets, what we know to be true right now. Are our tax rates going to be higher or lower? The tax rates are going to be higher or lower now or in retirement. And then if it's advantageous, right, if it looks like we're going to end up paying more, or the tax rates are going to be higher in retirement than they are now, then we can either change our retirement contributions to Roth, switch our 401k contributions to Roth 401ks if we're still working, or fund a Roth IRA, or we can do Roth conversions, which is where we, switch money, we take money out of our Roth IRA or our traditional IRA, right? We can, instead of waiting to withdraw it later and getting taxed at that point, we can take contributions or money from our traditional IRA, pay the taxes now, and then it can then at that point grow tax-free in the Roth and come out tax-free later on. And so rather than being, taking them out later and not knowing what the tax rates are going to be, we can guarantee what our tax rates are going to be now because we know what they are right now. And so whether it might be advantageous for you to change your retirement contributions to Roth, it might be more advantageous to convert it, wherever it is in your situation, right? But you need to calculate those things or get someone to calculate it for you and either do some contributions or some conversions. So that's rates. Those are tax rates. Those tax rates are increasing. Taxes are going up in 2026. We've got a short window here. The rest of 2022, if you're watching this real close to when it's coming out, if you're watching this live, and then just a few more years until we know tax rates are going up. So that's one tax bomb that's coming, is the tax rate bomb. That's going to cost you a lot more in taxes. It's time to prepare. It's time to get ready for that. The next one is the RMD tax bomb. And RMD stands for required minimum distributions. And the way that this works is that starting at age 72, you will be required to withdraw a certain amount, right? So you've been, like we saw in that thing, right? You've been putting all this money into your 401k, into your IRAs tax-free. You haven't paid a dime of taxes on that. And the government's going to let you grow that tax-deferred for retirement. But at some point, they're like, hey, where's my money? Right? You've been growing all this money. You've been getting super wealthy. You're not paying any taxes on it. We need it. Show me the money. Right? And so they will force you based on your age and how much money was in your retirement accounts at the end of last year, your IRAs and your 401ks. They calculate all that up. All that's reported to the IRS. They know exactly how much you have. And based on your age and that number, they will calculate an RMD, a required minimum distribution, and you have to take that out of your IRAs or 401ks, and of course pay taxes on it then. If you don't take that out, right? If you get your RMD and you're like, I just don't want to take it, I want to leave it in there to grow tax deferred. Well, then you're going to pay a 50% penalty on any money that's not distributed as part of your RMD. 50%, right? So like you know, maybe you don't want to take the money out because you're in a 25% tax bracket, and so you have to pay 25%. Well, if you don't, you're going to pay 50%. Half of it's just going to be gone. So you can't not do it. It's required minimum distribution, right? There's no way around that. And here's the thing, right? RMDs can push you into a higher tax bracket than you want it to be in, right? Maybe we're planning to be in that certain tax bracket. You've done some planning. You're like, oh, well, you know, we want to spend about this much in retirement. Our house is going to be paid off, and we kind of estimated our expenses, and we want to spend about this much in retirement. And that should put us right in a good tax bracket, so we feel good about that. And then, boom, RMDs hit. And it makes you pull a whole bunch of money out of your accounts that you didn't want, and it's pushing you into a different bracket. And here's the other thing, right? Is you can't put RMDs back into IRAs or Roth IRAs. Once you pull that out, because you have to be working in order to make contributions to either of those. And most people, by the time they get to age 72, are not working anymore. And if you do conversions, those don't count towards your RMDs. So you can't take that money out of your IRA like to satisfy the RMD and put it into a Roth as a conversion. It has to be a straight withdrawal. You have to pull that out and pay taxes on it. And here's where we come back to some of our other accounts in here again. Let's boot this back up. And you'll remember this page here. We have another type of account here. We've got just traditional non-retirement accounts. Oops, there we go. Let's make that a little clearer here. Non-retirement. So with these non-retirement accounts, and contributions to those are after tax, right? We don't get any tax benefit on that. Any growth in here is taxed as it grows. You pay taxes on interest, you pay taxes on dividends, and when you pull money out, right, you're also taxed on the capital gains, on the difference between what you put it in and what you took it out for. So you're taxed here, and you're taxed here. And so with those RMDs, when you need to pull those out, you're required to pull those out. You can't put them back into a traditional IRA, and you can't put them in a Roth. You have to. The best chance you have, if you want to keep that money invested because you don't actually need the income, the best thing you can do is put it in, after you pay that taxes, put it in a non-retirement account, and then continue to get taxed on it over and over again. And the difference between tax deferred, right, this growth here, and having taxable growth is thousands of dollars in taxes over the course of that account's lifetime. And so, right, that RMD can make you withdraw more than you want to, and then force you into an even more taxable situation if you didn't need that money. The other one that we want to look at quick here is the inheritance tax bomb. Now, we're not talking about the estate taxes, right? You probably heard about that, estate taxes or death taxes or these things, right? But estate taxes only affect a few Americans. Very few people are affected by the federal estate tax. There's some states that have much lower estate taxes. Minnesota is one. There's a bunch of other ones. But at least federally, right, you only pay estate taxes on amounts over about $12 million each. Right? So if you're a couple and you adult wealth, like unless you have more than $24 million in total assets that you're trying to leave to your kids, right? Not including stuff you're trying to send to charities or any of that. You're trying to leave it all to your kids or non-charities. Unless you have more than 24 million, you don't have to worry about estate tax. Now again, they could change that. They could drop it way back down. So it's something to be aware of, and that's a whole nother topic for another day. But in general, estate taxes is not going to affect too many kind of middle America, right? But inheritance tax is not an official term, it's just what I'm calling it. These affect many Americans. And what I mean by this is that when you pass away and you've got all your money in traditional IRAs and 401ks, and all that money passes to your kids or grandkids or whomever, right? Those beneficiaries must withdraw all that untaxed money within 10 years. They have 10 years and they have to pull all that money out of those accounts. And so then that's all taxable income to them, and it's going to get taxed at their highest tax rate. So even if you did a good job trying to keep, the money that you made taxed at a low rate through some tax plan and whatnot, if you got a bunch of money left over in your IRAs at the end, that's going to pass to your kids, and they're all going to get taxed on it. So you're not really, if you had $1 million in your IRAs that you're leaving your kids, and you're like, oh great, I'm going to leave them $1 million. No, you're not. No, you're not, because they're going to have to pay a bunch of taxes on that. And they're going to get this huge inheritance tax bomb. And if they're already, making it, they've done well, they've planned well, have a good, stable income in retirement. Now it's getting added on top of that, and they're paying a boatload in taxes. And so it's kind of the inheritance tax bomb. All right, those withdrawals, again, taxed at their highest tax rate. So let's look at an example here. And we looked at e-money a little bit in our last workshop on Social Security. This time I just have some screenshots. It's way more interactive live when we're actually working with people, but at least this way we can show you a few things. So this is Arnold and Emma D, or RMDs. You like that? So this is an example of how RMDs can affect people, right? So this is their situation. They're 63 and 61 or something like that, right? They're still working. They're going to retire at the end of this year here, and so they're growing. They've been good savers and whatnot, and they're growing. They're going to end up with just short of $1.5 million at retirement. And then they're going to live and they're following the 3D retirement income model, which you can learn about in the book. You can go back and watch our last month's workshop if you want a sneak preview of that, or you can read the book. It's free if you're a RetireMember. So again, go to RetireMembership.com and join up in our free membership community. We can get you a copy of the audio book or the physical book, whatever you want. You can listen to that, figure out that. But basically the concept there, right, is that they retire with, in this case, even more, or they pass away with even more money than they retired with, because they've invested in a way and they've planned in a way that they should in general be able to live off the gains each year. And so you don't see that, the assets going down in retirement. They're just living off the growth each year there. So they're doing a really good job there. They're actually, passing away with more money than they're retiring at. So like, awesome. I think he's living till like 80, I think he lives till 90 and she lives out till age 95, and she's a little bit younger. She's got a few years without him there, but plenty of money. They never have to worry about that. But this hasn't solved the tax problem yet. And here's what we mean, right? So this is their income then each year. They earn about $150,000 a year. And so that's their salary right there. And that last full year working, and then retire December 31st of that year. This red line here, it's lower in this first year because it's just looking at the end of 2022. But in these full years here, this is how much money they're planning on spending. And so they're actually spending less while they're still working than they make, right? Because this is all going to saving for retirement and taxes and these other things. But that's how much they save there. But then when they retire, they're actually planning to go up. They're planning to spend more because they want to travel. They've done a good job saving. They've got a whole financial plan that's going to allow them the freedom to enjoy that money without worrying about running out, right? And so they're planning to take the first 10 years and just spend more and more money, right? There's some inflation in there, obviously, that's going to account for that, but they want to spend a bunch of money. They're going to tone it back, right? We call these the go-go years. You've got a lot of money. You've got a lot of freedom now. You think before retirement, right, you spend the most money on Friday nights and Saturdays. And when you're retired, every night's a Friday night and every day is a Saturday because you don't have anything to do. So they're doing the go-go years. They're spending a lot of money. They're having fun. Then they spend the next decade or so kind of in the slow-go years. They're getting up there in age. They can't get out as much. It's a little bit harder. It's a little bit more tiring. He's even older than she is, right? And then after that, they have the no-go years, which is they're pulling back even more. More of the kids and grandkids are coming to them, still spending money, still enjoying it, but not quite as much. And so what we see here too, this blue stuff here, this is their Social Security income that's coming in, right? So this teal one here, that's their salary. Social Security is this dark blue that comes in each year. They've optimize that. It does drop, right? When he passes away, they lose one of them. She gets to keep the larger of the two, so that'll continue. And then you've got withdrawals. Here's the extra money they're pulling out of their retirement accounts, following that 3D retirement income model, and they're able to take more and more out each year to keep up with inflation, right? You got to beat inflation, and they're still, again, just living off that growth, even as their income increases each year. The account balance never goes down. Obviously, like in real life, it'll, kind of do some of this stuff or whatever. But as far as linearly, that's how that looks. But then we've got this required minimum distributions, right? RMDs. And early on, when he first hit 72, they're not too bad, right? And they'll start growing and growing and growing. He's the one with the big IRA, so it's just his RMDs in this situation. But as they get older, and because their accounts aren't actually going down, which is a good thing, right? We don't want the accounts to go down, but it does create this problem where because the accounts aren't going down, he gets older, the amount that he's required to take out goes up each and every year. And eventually, and if he kept living, it's going to make him take out more and more each year than they actually want to. And when he passes away, now all of a sudden she's in single tax brackets instead of marrying filing jointly tax brackets. But she still has to take his RMD. And so even though she only wants to spend this amount of money, it's forcing her to take out that. And she has nowhere to go with that, right? You can't put that in a Roth. You can't put that in an IRA. So down the road, this is going to create a big RMD tax bomb for her and forcing her both into a new tax bracket and paying the highest possible tax rates in that bracket. So what do we do? How do we account for this, right? We look at in the retirement accounts in base fact, we haven't done anything yet, right? They had a bunch of accounts, 401ks, IRAs, all that. They rolled them into just 2 IRAs. They spent down one. He's living on his. This is all just, Arnold's big IRA. And here's their taxes, their income taxes before we've done anything. He's paying a lot in taxes when he's working. That comes down for the first couple of years. And then right here, this big jump in taxes here, that's 2026. That's that year when just overnight, even though they're spending the exact same as they did the year before that, their tax rates go up and they start spending a lot. So they got the go-go years, that comes down a little bit for the no-go years. But then when he passes away and she's now in single rates, you see this tax rates going way, way up, and she's paying a bunch of taxes. Not only is she having to pull out more than she wants, she's paying way more taxes than they ever have, even though it's just her, right? So what do? Well, that's where we open up a Roth IRA and we start doing some conversions. We don't actually have to convert that much, but in this scenario, what we looked at is, and this of course is a fake client, but I've done this with real clients, is in these first 4 years here, from the end of 2022 all the way up through 2025, we just move a little bit each year. Keep it below, in their income, we keep it below a certain tax bracket, so we're not pushing them into a new tax bracket. But we just convert a little bit in that year, and then they continue to live off just the IRA like they were before, right? And they just let this Roth here just grow. And just let it grow. And of course, if they ever had one big expense inside of a year and they didn't want to bump up in a new tax bracket, they could always pull that out of the Roth IRA because it'll come tax free and it doesn't mess with anything. Well, in this case, they just keep living off the IRA, keep letting the Roth grow. And in the end, right, we look at a couple things, right? So because they're spending this down after it's converted, like now there isn't as much in there, and so they're not technically living off the growth of just the IRA, but in general, of course, their total portfolio is still even. It's going to now lower their RMDs. So instead of this coming up and up and up as his IRA continue to grow, because that is being spent down or some of it was converted, these RMDs are now lower. And so even when she's in single tax brackets, we can see that is lower than she actually needed. So now she's not having to pull out that extra cash, not having to pay those extra taxes. If we look at their overall portfolio, we actually see that we've lost money, right? That in the end, they had a little bit less total assets than they did if they hadn't done any of the conversions. And that's what CPA is always talking about, right? Hey, if you do all these Roth conversions, you're going to end out with less money. But of course, that's where we got to go back and look at, okay, but what kind of money do we actually have, right? Because again, looking now at them side by side, we avoided all these RMDs, all this excess distribution here that would have been here. Now we don't have to take out. All that can stay in tax-deferred retirement accounts. And what's more, when we look at the assets back to back, again, all this is IRAs, which means that at the end, when they've got, $1.5 million to leave to their 3 kids, all of this is taxable to their kids. Their kids are all going to get $500,000. That's completely taxable, and they have 10 years to take that out. That's $50,000 a year. That's then going to get stacked for them, right? They're going to be retired at that point. And so, they've also, mastered their income to keep it within a certain tax bracket. And now their kids got all this extra income on top of that for 10 years that they're going to pay at their highest marginal tax bracket. But after the conversions, now look, of the same, the scale changed a little bit here. Unfortunately, I can't get it to keep the scale the same. They still have just about the same, a little less, but still about 1.5 million total. But now look at this. All of this is tax free, right? It's all a Roth IRA. And they got a little bit of taxable money at the end that, will get distributed, and sure, they'll have to pay taxes on that. But all of this is now tax free. And so instead of getting $500,000 each that they have to pay tons and tons of taxes on, they each get $500,000 that they can do whatever they want with because it's entirely tax free. And in the end, what it costs, they have a couple $100,000 less, but not near as much as their kids would end up if they had to pay taxes on all of that. And so that's just an example of the power of conversions and the power of, what can happen in the end. Again, it's not always about what's the total amount of assets you have. It's more about what's the total amount of tax-free assets, or what's the total amount of assets you're going to have after tax, or that your kids are going to have, or your grandkids, or your churches and charities, wherever you want that money to go in the end. What's going to be left and how is it going to be taxed? And in that way, conversion, especially now while tax rates are lower, can be an awesome thing. And we've seen a lot of scenarios where people can do it. Actually, let me show you one more thing here while I think about it. Let's pull this back up here. The other thing to think about, though, is you still have to calculate it. This is not a done deal like, oh yeah, do a bunch of conversions, convert up to the top of the next tax bracket, whatever. When we actually looked at this and did some calculations for this example, and again, I've done similar calculations for real people, they actually didn't end up converting that much each year. I think they converted less than about $100,000 total of the $1.5 million they had. And they did it over 4 years, maybe 120,000 or something like that. And that's it. That's all they had to convert. Because if they converted too much and even max out that tax bracket, what would happen then is the IRA portion of this, it'd be a lot less to begin with. And so that would spend down like that. And then what would happen is they would have all these years at the end where, yes, they would have now a completely tax-free retirement, and they wouldn't pay any more taxes for the rest of their retirement, right? And so their tax rates would look like, they paid more taxes up front here during the conversions, and then they'd pay all these taxes, and then it would just drop off, and they'd pay 0 taxes for any of this years here. And that sounds great, 0 taxes in retirement, that's awesome. But again, that's actually not awesome. It's a horrible idea, because if we go back to our tax rates, right, we always get $26,000 that's already tax-free. And then we already get another $20,000 that's only 10%. And I don't think that's ever going to change. That tax rate, that bracket's been pretty consistent for a really long time. And so to go to a point now where you are converting and paying, 22%, which is what they're paying, you're paying, converting a whole bunch at 22%, then later miss out on a whole bunch of 0% standard deductions for years and years and years, they will actually end up paying way more in lifetime taxes than if they convert the right amount. So it really is like a kind of a science. Obviously, there's some things that can happen, and you can't be sure exactly how much is going to, how this is going to work out. But there's some calculations and some good projections that you need to be able to do so that we're converting the right amount, but not over converting and end up paying more taxes over a lifetime because we put too much in a Roth and didn't leave enough in traditional for those low, those later standard deductions and tax rates. So that's where, again, you really got to have a good plan, figure out exactly how much you should convert, and then do that. And you can get someone to help you with that if you need. So let's look at a couple other strategies to reduce these, right? We've got these tax bombs, you've got the tax brackets coming up, you've got RMDs, and you've got inheritance tax. All these things are coming up that can end up costing you, and all the stuff that you've built, all this hard work, all the savings that you've done, and the government can come in and take a huge amount of that, tons of extra taxes if we're not proactively planning. So Roth conversions, QCDs, HSAs. Let's run through these quick because we're almost at the hour. Roth conversions, right? We've already been talking about that, but again, just to sum up, right? We want to proactively convert instead of reactively withdraw. right? Once you get out to RMDs, you got to withdraw. It's required, and you're just now going to be reacting. You can't keep that in a Roth. So instead of pulling that out later in retirement and then just having to stick it in a brokerage account, non-retirement account, let's proactively take that out and put it in another tax-free account instead of a taxable account. That's the main objective there, right? Roth becomes tax-free, whereas unwanted RMDs become further taxable. And so let's be proactive. Let's not be reactive. And then last, skip through that one on accident. Lost that one. That's all right. QCDs, or qualified charitable distributions. Here's the next one we want to chat about. After age 70 and a half. So 70 and a half used to be the RMD age. They moved the RMDs out to 72, but they didn't move the QCD age. I don't know if they just forgot about it or what, but that's still 70 and a half. But after age 70 and a half, you can send any money straight from an IRA, straight to charity, and pay zero taxes on it. It's completely tax-free, right? And so if you are already charitably inclined, and you're given regularly to a church or to charities that you support, right? Once you hit 70 and a half, you'll immediately want to stop giving any money out of your income, out of your Social Security, your normal withdrawals. And what you're going to want to start doing is giving that money straight out of your IRAs. Any custodian, right? We use Schwab, but any custodian can do this. You just set it up at a time, and then you can get them to send as much money as you want, whenever you want, straight to the charity, and then it's completely tax-free, right? Because, if you're in a 25% tax rate, and you want to give $1,000, right? You have to pull out $1,000. You're going to pay 25% taxes on it. And now you're only able to give $750. But if you can send that straight to charity, you don't pay the taxes, and so they get the full $1,000. So it's either A, you can save taxes and send the same amount, and then you save 25% taxes for yourself, or you can basically send 25% more and it's the same amount out of your pocket, but because the government's not getting cut, now the charity is given even more. So either way, right? Either you can save money and have more in your accounts, or the charity can get more money. Either way, let's cut the government out of it. Because it doesn't matter who's in charge, right? Whether it's your people or the other party that you didn't vote for, it doesn't matter. Nobody wants to pay extra taxes. You're going to do a better job with it, and certainly charities are going to do a better job with your money than the government is, right? So that's a great way to start giving, making a bigger impact with what you have and reducing those taxes. You can also, and you don't have to be 70 and a half to do this one, you can give appreciated investments to avoid those taxes. So that last column or that last bucket we talked about, if you've got non-retirement investments, you bought them for $1,000 way back in the day, they're now worth $5,000. If you take that out, you now owe taxes on that difference, right? You paid $1,000, it's now worth $5,000, so you're going to pay taxes on $4,000. Or you can just give the whole thing straight to a charity. Charities don't pay taxes, right? They're tax exempt, so they can sell it at that point, and then they get to keep all of it. And that way, again, instead of selling it, having to pay taxes and giving the remainder, you can just give the full amount straight to charity and not worry about. So there's a few different charitable ways that you can give money to good charities who are going to do great things with it, good churches, those types of things, instead of the government who's clearly just going to waste it. And then the last strategy here, health savings accounts. If you're still working and you've got a high deductible health plan, right, you can make HSA contributions. A lot of people do this, but a lot of people waste a lot of opportunity here because they only put as much in their HSA as they think they're going to need for current day health expenses. But here's the thing, right? First of all, HSAs are the best accounts ever because they're the only way to get the triple tax advantage. And here's what we mean by that. Let me gear this back up here. One more time, we'll look at that last account in the corner there. So, this last one, HSAs, the best account because contributions are pre-tax or tax deductible, depending on how you do it. Either way, you don't pay taxes on any money that you put into an HSA. The growth on that is tax deferred, same way it is in retirement. As long as it stays in the account, you don't pay any taxes on that growth. And when you pull that out for qualifying health expenses, those withdrawals are also tax free. You don't pay any. So again, pre-tax, tax deferred, tax free. It is the triple tax advantage, and for that reason, it is the best account ever. It's even better than a Roth. And so if you've got these, right, contributions are tax deductible, HSAs can be invested, and the growth can grow tax deferred. So a lot of people, again, they have an HSA, but they put a lot of money in and it just sits in a bank, and an HSA at a bank doing nothing. But you can open an HSA that gives you money, that you can invest it in equities and all these things just like anything else, and you can grow that money for retirement. And those distributions are tax-free if they're used for qualifying health expenses, right? And that includes Medicare premiums. That includes a bunch of things. We got a whole list of them that it will count for. And as long as you spend on those things, which again, when you're retired, your health will decline. You'll have plenty of health expenses. It becomes a great way to get that triple tax advantage in retirement. You can go to RetireMembership.com/HSA, and then we've got some different resources. We've talked a lot about HSAs between podcasts. We got a whole list of all the qualifying expenses that you can spend it on. It's also open enrollment for a lot of people right now. So if you're looking at a high deductible plan, it's always good at least once a year to go back and check on what your what expenses are those? Because I think a lot of people forget some of the expenses that you can spend those on, and they're spending money out of other accounts. And so, yeah, go to RetireMembership.com/HSA. Just bookmark it for later if you don't have time after watching this to use it. There's a lot of great resources on there. HSAs are one of my favorite accounts. I call them health super accounts for that reason, and that's going to be a great place to find a lot of information about those. So we've covered a lot. Right? We looked at the tax bombs. We've looked at strategies to do it. We looked at how important it is to do tax planning and not just tax preparation. At the end of the day, all I can say is you got to get a retirement plan. Right? If you don't have, is this the first time you're hearing any of this and you've already been working with someone a long time, that's a red flag. Right? You should have at least heard a lot of this stuff, really all of this stuff, if you already have an advisor. I think a lot of people don't have financial advisors. They don't have financial planners. And you're just kind of, maybe you're looking at retirement for the first time. But listen, you got to get a retirement plan because the tax planning component of planning for retirement can save you and your heirs thousands of dollars, right? It's just too important to ignore. And one last thing, right? The deadline for Roth conversions, which we spent a lot of time talking about today, is December 31st. It's December 31st, right? So that, you can do a lot of other things till April 15th and whatnot, not conversions. And so, this is airing November 17th. If you're watching this live, you got a month and a half before they have to be done, which means you have a month and a half to start them. So we're here to help. If you need help in a pinch and you're like, man, I really think I need to do this, but I need to do some calculations. I want to make sure I'm not doing too much. We're here to help. We can work with you and make sure you get that right. And, if you need that advice, then you need to get a fee-only fiduciary certified financial planner, right? Someone who's not earning commissions, not there to sell you stuff, who's got all the competence, all the expertise to teach you all this stuff and help you do it all. And who really knows the planning aspect of it. Bonus, if you can get someone who's also duly licensed in tax advice as well, because then they don't have to keep telling you to go ask your tax advisor. They can just give you the advice. So you can go to feeonlynetwork.com. I'm not affiliated with them anyways. That's just the best resource I know to find these types of planners if you don't already have one. Or, of course, you can work with us. RetireMembership is just educational, but I have a financial planning firm, Lacrosse Financial Planning, that you can find at laxfp.com. And you can check us out there, schedule a discovery meeting. Call us, whatever you want to do, and we can help you do your tax planning, help you do retirement planning, help you save thousands of dollars in extra taxes so that you can keep them for you and your family and what you want to do with it. If you haven't ever been, go to RetireMembership.com. It's where all of our content is. We've got podcasts, we've got workshops, we've got all kinds of stuff. It's continually being updated, continually being revised. You visited a long time ago, you haven't been there recently, step back in, figure out, all the new things there. And then, connect with us, right? Email us, questions@retiremembership.com. If you got questions about reducing taxes or anything else we've talked about, you can do that. Become a retirement member if you haven't. It's a free community. There's no cost at all. We don't ask for a credit card to keep on file or anything like that. It's 100% free. We just want to help you retire successfully and stay successfully retired. So you can go to RetireMembership.com. Become a retire member. Listen to the podcast. Comes out weekly on all the places where you'd normally get podcasts. And if you enjoyed this, right, if you thought this was helpful, first, thanks for investing the time. You could have done anything with this hour. And I love that you chose to learn about taxes. Not always the most exciting topic for a lot of people, but it's super important and it's way too important to ignore. And so thanks for investing that time. If this was helpful to you, right, if you're like, man, I learned something today that I didn't know and I can see how important this is, then I would just ask, I think the least you could do, right, is just give this video a like, hit subscribe if you want to see other videos, if you feel like we've earned that, right, if the content that we just delivered is good enough to earn a subscription, you want to make sure that you're seeing anything else that we're putting out, then subscribe as well. And then if you could just send this video to anyone else, you got coworkers, you got a brother, you got a parents, you got somebody who's close to retirement or in that kind of that 50 to 70 age range. If this was helpful to you and you're like, man, I got to save taxes, this is some good stuff, then send the link to someone else. Help them out. I'm sure they would love it as well. And they're going to thank you for being the one that put them on to that content. again, we're here, RetireMembership. We're coming out with stuff every week. And we'll see you next month. We're doing our last workshop for the season, which will be on estate planning. How do we make sure that you get your money to whom you want it to go to, and keep it out of the pockets of attorneys and out of the pockets of the government, and keep the government from deciding what should happen with your stuff. So stay tuned for that. We'll be back next month again, and we'll see you each week on RetireMembership. Thanks again for watching, and we'll see you around. Cheers.